Welcome to the Deep Dive.
Okay.
We're here to cut through the noise, really extract the core knowledge you need from, well, a tile of information. Today, our mission is pretty laser-focused,
Sure.
understanding the top 10 publicly traded U.S. companies really leading the charge in robotics and artificial intelligence integration in 2025.
Right.
We're aiming to give you, someone who wants to get smart on a topic quickly but thoroughly and loves those aha moments, a real shortcut to being well-informed.
And to do this, we're digging deep into a really comprehensive investment analysis. It's called DR 2250-520 Robotics Investment Analysis 2025.pdf.
Think of it as our expert-level briefing doc for today.
Exactly. And this isn't just skimming the surface, right? This analysis gives us a real inside look.
Yeah.
It covers how these 10 key companies were picked, gives us SWOT analyses, strengths, weaknesses, opportunities, threats.
Classic framework.
Right. It maps out the competition, who they're battling it out with, and even looks at how policies, like from the Trump administration, have played a role. It also gets into the tech advancements, critical insights, what these companies actually sell, their financial health, how they're weaving AI into everything, and it wraps up with investment recommendations. Looking out 3 years.
It's a really broad scope. We're talking major players,
Yeah.
Tesla, NVIDIA, Amazon, iRobot, Intuitive Surgical, UiPath, ABB's U.S. side.
And others too, like Symbotic, Deere, Alphabet, significant U.S.-listed firms. And this sector has serious momentum. Just think, in 2023, the global count of industrial robots hit a record 4.28 million.
Wow.
Yeah, that's up 10% from the year before. So that gives you a sense of the scale and, frankly, the importance of what we're talking about.
Okay, let's unpack this then. Let's get to know these companies through their profiles and those SWOT analyses. First up, Tesla. Ticker TSLA.
Right.
Now, obviously known for EVs, but this analysis really emphasizes their role as an AI company, Autopilot, the Optimus robot project.
Very ambitious stuff.
Yeah. We're talking a market cap north of $700 billion, 1.78 million EV deliveries in 2024. And what's interesting is how self-reliant they are designing their own chips, like Dojo for AI, running their own charging network.
That vertical integration is a key strength highlighted in the analysis. It helps them leverage their brand, that strong customer loyalty they've built.
Right.
And their AI advancements, it's not just full self-driving, it's robotics too. That gives them a notable edge. Controlling production, batteries, software, it means, well, efficiency and faster innovation.
Plus that whole ecosystem they built.
Yeah.
EVs, energy storage, solar, multiple streams.
Exactly.
But it's not always a smooth ride, is it? The analysis points out some concerns. Production and delivery have been a bit volatile now, and those auto profit margins got squeezed, dropped to 7.2% in 2024 from, 9.2% the year before?
Yeah, that's a noticeable dip. And then there's the reliance on Elon Musk, the classic key person risk.
Right, and ongoing, talk about quality control, service issues, those haven't gone away.
But look at the opportunities. The planned robotaxi service, maybe by 2026, the Optimus prototypes, these could tap into huge new markets.
True. And any regulatory shifts favoring autonomous ride-sharing, that would be a massive boost for FSD.
Absolutely. Plus, the growth in renewables, battery tech improvements, it all plays into their long-term strategy.
Okay, but threats are real too. EV competition is heating up BYD, for example.
Definitely.
Regulatory hurdles for autonomy are always there. Changes in EV incentives could hurt demand.
And supply chain worries, lithium, chips, plus macro stuff like high interest rates making big purchases tougher.
So the takeaway seems to be bold AI and robotics moves, huge potential markets, but execution risks are significant. And that valuation, around 100 times earnings, is pretty rich. Needs balance.
Well put. Okay, let's switch gears to NVIDIA. NVDA.
Yeah, the giant.
The dominant force, really, in GPUs and AI chips. Market cap around $2.9 trillion in early 2025. Just staggering.
Their processors are basically the engine for AI everywhere, right?
Yeah.
Robotics, autonomous vehicles, data centers.
Pretty much. They've got the hardware A100, H100 GPUs, the Jetson modules for robots, and this powerful software ecosystem around CUDA.
Right. CUDA is huge for developers.
It really is. Plus all their AI libraries. They basically own the high-performance computing and AI training market, something like 80% market share.
80%?
Wow. Yeah. And the financials reflect that. Revenue up 114% year over year recently. Gross margins around 75%.
And they're pouring money back into R&D, aren't they?
Oh, yeah. $12.9 billion in fiscal 25. That's up nearly 50% year over year. Huge commitment to staying ahead.
Okay, so strengths are clear. Tech leadership, that strong software ecosystem. But what about weaknesses? No company's perfect.
True, they still rely somewhat on the cyclical gaming GPU market. That can fluctuate.
Right.
And potential supply chain constraints, they depend on partners like TSMC for manufacturing those advanced chips.
That's a bottleneck risk.
It can be. Plus, maintaining that tech lead costs a fortune in R&D and capital spending. And then there are geopolitical issues like U.S. export restrictions to China affecting chip sales.
Got it. But the opportunities look massive, don't they? AI adoption exploding across industries.
Exactly. That's the huge tailwind. Plus, new areas like autonomous vehicles with their D-Drive platform, robotics with Isaac.
And edge computing, IoT.
Right. More demand for AI processing outside the data center. They could even move towards custom full-stack solutions, maybe pairing their Grace CPU with their GPUs.
Interesting. Threats, though. Competition must be heating up.
It is. AMD, Intel are stepping up. Lots of AI startups, too.
And the geopolitical stuff you mentioned, U.S.-China tensions.
Yes. Plus the risk that this AI investment boom could eventually cool off, maybe market saturation. And the tech itself changes so fast. What about analog computing, quantum? They need to stay agile.
Makes sense. But overall, strong financials, analysts expect more growth, though that valuation is high, like 45x trailing PE, 31x forward. Still premium.
Definitely priced for continued leadership.
Okay, next. The behemoth, Amazon.
Yeah.
AMZN. $638 billion revenue in 2024. E-commerce, cloud, obviously. But for us, it's that warehouse automation. Over 500,000 mobile robots deployed. That's incredible.
It's massive scale, and AI is just woven into everything, recommendations, Alexa, AWS, and they're looking to buy iRobot, remember?
Yeah, we'll get to them. So Amazon's strengths? Unmatched e-commerce scale, where robots and AI drive efficiency.
And that dominant AWS cloud business, huge cash flow, deep AI expertise in-house.
Plus constant logistics innovation, Kiva, Proteus robots, drones, and that massive customer base. Prime, Alexa. That's strong moat.
A very strong moat. But they face challenges too. Retail margins are historically thin, high fixed costs, though the overall operating margin did improve to 10.8% in 2024.
Still pouring money into fulfillment centers, data centers. Lots of capital spending.
And increasing regulatory scrutiny. Labor relations can be tricky too.
Opportunities, though. More automation, surely. Maybe even licensing their tech.
That's a possibility, the analysis notes. Expanding AI services, generative AI in AWS and Alexa, and integrating iRobot with Alexa could be really powerful for the smart home.
Plus international growth potential.
Always. But threats exist too. Cloud competition from Microsoft, Google is fierce.
And online retail, Walmart, Shopify are pushing hard.
Right. Plus potential data privacy, AI regulations, geopolitical risks hitting supply chains, and maybe market saturation in some core areas eventually.
Still, the analysis highlights that growth re-accelerated in 2024 and margins improved significantly. So momentum there.
Definitely. Which brings us nicely to iRobot. IRBT.
Roomba folks.
Exactly. Consumer robotics pioneers. About $1.6 billion revenue back in 2022. And that pending $1.7 billion Amazon acquisition looms large, though it was still under review in early 2025.
Their AI is focused on home mapping, avoiding obstacles, that kind of thing.
Right. Strengths. Iconic brand, first mover advantage, real tech expertise in sensing, mapping, decent portfolio vacuums, mops.
And strong distribution.
But weaknesses too. Premium pricing is one.
Yeah, they aren't cheap.
And their product range isn't super wide beyond cleaning. They depend heavily on consumer spending. And competition's tough. Plus, those U.S.-China tariffs hit their margins back in 2019.
Opportunities. Smart home integration is huge, right?
Massive demand there. Plus, international expansion, maybe new products they explored, lawnmowers, and potential for recurring revenue from software or services.
But the threats seem pretty serious. Competition is intense. Ecovacs, Roborock, Shark Ninja, Samsung.
A crowded field. And technological disruption could always happen. Data privacy with home maps is a potential issue too.
And the analysis basically says if that Amazon deal falls through,
they face a real uphill battle as a standalone company. Their value might really depend on being part of that bigger Amazon ecosystem.
Makes sense. Okay, let's shift to the medical field. Intuitive Surgical, ISRG.
The leader in surgical robotics, the Da Vinci system.
Over 10,000 installed worldwide. $7.1 billion revenue in 2023, up 14.5%. And a lot of that is recurring revenue, right? Instruments, maintenance.
Yeah, high margin recurring revenue is key, over 70% of their business. They're also innovating new systems like Ion, AI-enhanced endoscopy in the works.
Strengths are pretty clear then. Dominant market position, broad portfolio, that huge recurring revenue stream.
Global reach, large and growing installed base, big R&D investment.
Weaknesses. The the cost of the systems is substantial.
Very. $2 million upfront plus maintenance. That's a big ask for hospitals.
And they rely heavily on certain key procedures. Growth might be slowing in developed markets where they're already established.
That's right. And the tech is complex, needs significant training.
Opportunities. Expanding into new types of surgery.
Definitely. General surgery, orthopedics. Plus, integrating more AI and machine learning for precision, for training, and growth in emerging markets is a big one.
Partnerships with healthcare systems, too.
Threats. New competitors are emerging. Medtronic, J&J are getting into the space.
Regulatory and legal risks are always there in medtech.
Always. Hospital budget constraints could bite. Changes in healthcare reimbursement models, too.
But the report notes strong recent demand. Procedure volumes up 17%. Revenue up 19% in Q1 2025.
Yeah, suggests their moat is still formidable and innovation is paying off.
Okay, moving to software. UiPath. Path.
Leader in robotic process automation, RPA software. Strong brand, went public in 2021.
Their platform integrates AI and machine learning, right?
Yeah.
Studio, Orchestrator, AI Center.
Exactly. Comprehensive suite. Strengths include that leadership position, the integrated AML, a robust partner ecosystem. Think Microsoft, IBM.
And they focus a lot on training. UiPath Academy.
Over 1 million developers trained. Big community focus. That's a strength.
Weaknesses. Heavy reliance on North America, like 60% of revenue.
That's a concentration risk. Pricing can also be seen as high for smaller firms. And the software's complexity means training is really needed. Plus, operating expenses have been rising.
Opportunities seem big, though. Demand for automation is growing everywhere.
Huge market. Global RPA could be $13–14 billion by 2028, plus expansion into emerging markets, deeper AI integration, especially generative AI, acquisitions maybe, and growing their cloud SaaS offering, Automation Cloud.
Threats. Competition, again. Automation. Anywhere. Microsoft Power, automate.
Definitely intensifying potential market saturation as big companies get automated. Tech convergence too, maybe AI agents start doing RPA tasks.
And cybersecurity, data privacy concerns with automation?
Always relevant. So robust revenue growth, though it's moderating a bit, improving operating margin, but still a high forward PE.
Got it. Now for a big industrial name, ABB Ltd. ABB.
Swiss-based global conglomerate, but big U.S. operations, listed on the NYSE. Top player in industrial robotics, factory automation.
The robotics division is key. Company revenue was around $28 billion in 2022. Market cap, maybe $15 billion in early 2025.
Strengths. Global footprint, huge installed base, massive product portfolio, over 1,000 automation products, lots of robot families, cobots.
Cobots, collaborative robots, right?
Exactly. Strong innovation commitment. R&D was $1.5 billion in 2022. Well-recognized brand, diversified across many industries, strong service network.
Weaknesses. Depends heavily on big markets.
Yeah.
Europe, U.S., automotive.
Yes. Requires high capital investment, maybe less agile than pure-play robotics firms, exposed to currency swings too.
Opportunities. That surge in automation demand, reshoring trends.
Big drivers. Growth in cobots, flexible automation, digital services, AI integration via their Ability platform, expansion in high-growth markets like China, India.
Threats. Strong competition from names like Phonic, Yaskawa, KUKA.
Fierce rivals, pricing pressures, geopolitical and trade risks, and risks in executing big, complex projects.
Or the analysis showed robust financials in 2024. Stable balance sheet pays a dividend.
Yes, a solid industrial player adapting to the automation wave.
Okay, now for a newer name, Symbotic, SYM.
Right, came public via SPAC in 2022, focused on AI-powered warehouse automation, end-to-end systems.
And their marquee client is Walmart, using them in all U.S. regional distribution centers.
That's the huge partnership. Walmart is a customer and an investor. Gives Symbotic a massive order backlog, around $22.7 billion.
Wow, $22.7 billion backlog. Strengths also include efficiency. Their tech is cutting edge, and they've shown they can scale these big deployments.
Definitely. Weaknesses, though, huge customer concentration with Walmart.
Yeah, that's a risk.
Not consistently profitable, yet still seeing net losses. Some recent accounting and financial control issues were mentioned, and these are capital-intensive projects, strains cash flow.
Opportunities,
Yeah.
International expansion, maybe with Walmex.
That's one possibility. The overall warehouse automation market is booming, potentially $430 billion, recurring revenue from software, maintenance, and diversifying their customer base over time.
Threats, competition again, Berkshire Grey, Honeywell, Ocado, even Amazon Robotics internally.
Crowded space. Operational risks in scaling up to meet that huge backlog. Losing key relationships would hurt. And macroeconomic factors affecting retailer spending.
But a strong growth story, revenue up around 44%. Projected profitability in FY 2025.
That's the narrative. High growth, high potential, but also significant risks.
Okay, finally, Deere and Company, DE.
The tractor giant, world leader in farm and construction equipment, $54 billion revenue in FY 2024.
But they're aggressively integrating AI and robotics, right? Autonomous tractors, smart combines, precision sprayers from their Blue River technology acquisition.
Exactly. They're betting big on smart farming. Strengths include that strong legacy brand, huge dealer network, advanced tech integration, GPS, IoT, AI like the autonomous 8R tractor, growing precision ag portfolio, historically strong financials, though 2024 saw a pullback.
Weaknesses. Cyclical depends heavily on the farm economy. Net income dropped significantly in 2024.
Right, from over $10 billion down to $7.1 billion. The high price of the new tech might slow adoption too. Integration challenges on rough farmland. And competition in precision ag is growing.
Opportunities. The potential for automation in agriculture is enormous.
Huge. Upgrades and retrofits for their massive installed base. Growth in sustainable farming tech like their See and Spray. New markets. Recurring revenue from software and data.
Threats. Competition from traditional players and new tech entrants. Regulatory hurdles for autonomous farm equipment. Adoption risk from conservative farmers. And macro factors like interest rates hitting farmer investment.
True. But the analysis concludes their proactive embrace of robotics, and AI positions them really well as a long-term leader in smart farming.
So looking across all these companies, understanding the competition is key. You mentioned rivals for each.
Right. NVIDIA versus AMD, Intel, cloud players, custom chips, Intuitive versus Medtronic, J&J, UiPath versus Automation, Anywhere, Microsoft, ABB versus Fanuc, KUK, Symbotic versus Berkshire Grey, Ocado, Deere versus CNH, AGCO. It's a dynamic field, everyone jostling for position.
And government policy plays a role too. The analysis look at the Trump administration's approach, generally laissez-faire on AI regulation, aiming to boost innovation.
That was the stated goal. The American AI Initiative in 2019. The 2020 principles, they talked about trust, transparency, risk assessment, but avoided hard rules.
Which maybe helped companies like Waymo and Tesla in the AV space. Less restrictive federal rules meant more state-level experimentation.
Arguably, yes. The federal vacuum allowed states to set their own pace. The DOT's voluntary AV guidelines also encourage development without heavy mandates.
And for collaborative robots, no major new OSHA rules was probably good for ABB and others.
Likely. On the funding side, there was increased federal money for AI R&D through DoD NSF grants supporting the ecosystem.
There were also tighter export controls on high-end AI chips and software to China, right? That hit NVIDIA.
It did. And the tariffs on supply chains caused issues. iRobot moved manufacturing. Tesla's Shanghai factory faced complexities. Intuitive Surgical lobbied for exemptions on components. Policy cuts both ways.
Okay, let's talk catalysts. What could really move the needle for these stocks, positively or negatively? Bullish side first.
Big tech breakthroughs are always key. Think Tesla's Optimus progress, NVIDIA's next chip generation like Blackwell, Intuitive's AI guidance systems.
Major partnerships or deals, like Amazon Robot if it happens, NVIDIA with car makers, UiPath with cloud giants.
Exactly. Market expansion too, Intuitive in China, Deere in construction autonomy, Amazon pushing into healthcare logistics, Tesla's Cybertruck or Robotaxi network, NVIDIA getting into ARM CPUs.
And just executing well. Symbotic converting that huge backlog into revenue.
Right. Margin expansion like Amazon Retail getting more profitable, UiPath hitting consistent profitability, and favorable policy Chip Possess Act for NVIDIA, Inflation Reduction Act for Tesla and Deere, maybe automation tax credits. High labor costs also push companies towards automation.
Okay, the flip side. Bearish catalysts.
Regulatory and legal issues are big ones. Antitrust for Amazon, Alphabet, AV bans or restrictions impacting Waymo, Tesla, product liability for Intuitive Surgical, Autopilot FSD investigations for Tesla, data privacy concerns for iRobot, Amazon.
Market saturation or slowing growth. Intuitive in developed markets, maybe AI hardware demand eventually cools for NVIDIA. Symbotic needing new orders after the current backlog. Cyclical downturns hitting ABB, Symbotic, Tesla, Deere.
All potential headwinds. Intensifying competition leading to price pressure, Medtronic J&J versus Intuitive, AMD Apple versus NVIDIA, Microsoft versus UiPath, ABB Fanuc price wars, warehouse automation bake-off versus Symbotic.
And execution missteps. Symbotic's financial restatements were a red flag. Tesla tech delays FSD, Optimus, Amazon warehouse accidents, product recalls for ABB, Intuitive, NVIDIA chip launch delays. Things can go wrong.
Absolutely. Execution risk is always present.
So looking at the actual products and services, it's clear how central robotics and AI are becoming. Tesla's SSD and Optimus, NVIDIA's GPUs, Jetson, Isaac platforms.
Amazon's warehouse robots, Alexa, Astro, Waymo driver for autonomy, iRobot's Roomba AI, Intuitive's DaVinci, UiPath's RPA with AI vision, ABB's industrial and cobots getting smarter, Symbotic's end-to-end AI warehouse, Deere's autonomous tractors, See & Spray. It's deeply integrated.
And the financial performance reflects this varied landscape. NVIDIA, stellar growth, high margins from the AI boom. Amazon, reaccelerating growth, better margins. Alphabet. Rebound, improved profits.
iRobot, under pressure. Intuitive, consistent growth, high recurring revenue. UiPath, strong growth, aiming for profitability. ABB stable, moderate growth. Symbotic, high growth, losses now, but backlog is huge. Deere, solid but cyclical. Valuations are all over the map, reflecting these different stories.
And underpinning it all is that AI integration. Tesla's deep learning for FSD. NVIDIA powering AI compute. Amazon using AI everywhere from logistics to Alexa, Waymo's AI brain, iRobot's mapping. Intuitive surgical guidance, UiPath's intelligent automation, ABB optimizing robots, Symbotic orchestrating warehouses, Deere's precision ag. It's fundamental now.
It really is. It's not just an add-on. It's core to their capabilities, efficiency, and competitive edge.
Okay, so pulling it all together, the analysis offers investment recommendations on a 3-year horizon. What's the verdict?
All right, quick rundown based on the report. Tesla gets a hold, acknowledging potential but citing valuation and competition. NVIDIA. By strong AI leadership, continued growth expected. Amazon. By improving fundamentals, AWS AI upside. Alphabet. By strong AI, attractive valuation.
What about iRobot?
Sell if it stays independent. No rating if the Amazon deal closes. Intuitive surgical. Buy dominant position. Growth prospects. UiPath. Hold promising market but competitive pressures. ABB. Hold stable industrial, increasing automation exposure.
And the newer ones. Symbotic. Deere.
Symbotic, buy, but labeled speculative high growth, high risk. Deere. Hold, acknowledging the cyclical nature and tech adoption curve.
Got it. So summing up this deep dive, the impact of robotics and AI is clearly profound. It's accelerating across so many industries.
Absolutely. The overall outlook for the sector seems really positive, driven by things like labor shortages, tech advancements, just increasing acceptance of automation.
We expect continued growth across these companies, so at different rates, obviously.
Right. And competition is only going to get tougher. So innovation is absolutely critical. Data and algorithms are becoming the real competitive moats here.
The regulatory landscape keeps evolving, too. That'll be important to watch. And maybe more M&A, more convergence in the sector.
Very possible. Ultimately, AI and robots are just going to become more integrated into daily life, and these companies are really positioned at the forefront of that transformation.
Okay, on that note, here's something for you, our listener, to really chew on. Considering this incredibly rapid pace of advancement in AI and robotics, what are some completely unexpected industries or maybe aspects of daily life that might get significantly disrupted in the next decade? Things beyond what we've even talked about today.
Yeah. Good question to ponder.
Something to really sink your teeth into after our deep dive. Thanks for exploring this fascinating landscape with us.